Now that you've seen how people are able to buy houses, this podcast will be devoted to going into a little more detail about how the mortgage market relates to the banking industry, the investors in the giant pool of money, and more importantly, to the current global crisis. Here, we need to backtrack. Remember how I was talking about the giant pool of money and how they were looking for good investments with low risks and decent returns? Well, as said before, they went to these other types of banks called investment banks and they said, we want a good place to put our money because we have a lot of it. So the investment banks were looking at the market, and the marketplace did not look healthy. It was 2001, there was a dot-com bust, and the future of all businesses looked shaky except for one area. In fact, this area was so stable that it became a hot-button trend for our economy. It was the housing market. Now, I talked about when the Fed had lowered interest rates in 2001, the U.S. Treasury bill market's interest rates were now at 1%. Meanwhile, the housing market could give you a return of about 6%. So a lot of investors started switching to mortgages as investment products. But how do you turn a mortgage on someone's house to a form of investment? The larger question becomes, how are these two sides of the equation connected? How does a community of investors that have billions of dollars invest off of a tiny house mortgage? Well, the link between these two communities was the banking system. On one side, you had individual homeowners who bought mortgages from commercial banks, so they owed their money to commercial banks and would eventually be paying them back. Investment banks, on the other hand, were receiving money from investors in the giant pool of money, and they had to do something with this, and thus the missing link emerged. So we had these two different types of banks. One bank, the commercial banks, needed more and more money because with a booming housing market, they had more homeowners. On the other side were investment banks who had lots of money but didn't know what to do with it. That's when they decided to link their services together. The money from the giant pool of money was given to investment banks, and investment banks gave that money to commercial banks. Then commercial banks used that money to front money for homes so they could give mortgages to households. So you ask, how does the giant pool of money make any profit from this arrangement? Well, here's what happens. The commercial banks take all the mortgages that they're expecting from families and package them up together. Next, they take these packaged mortgages and sell them to investment banks for a fee. Investment banks take these mortgages and turn them into an investment product known as a mortgage-backed security. Then the investment bank takes these mortgages and puts it into a special entity called a special purpose vehicle, which is essentially a subsidiary of an investment bank. It then sells the rights to these mortgages to investors from the giant pool of money. When it becomes time for families to make their payments, their monthly payments no longer go to commercial banks, but are instead channeled to investment banks, who channel that money to special purpose vehicles where the money is then distributed to investors in the giant pool of money. And considering the risk of mortgages, many of these investors were looking at an average of a 3 to 6% return. To review, we learned how the banks connected the homeowners to the giant pool of money, and how the investors from the giant pool of money invested in mortgage-backed securities. Coming up, what went wrong with the mortgages as an investment product? How did this affect the investors in the giant pool of money? Thanks for watching. To learn more or watch more podcasts, visit www.subprimethemusical.wordpress.com.